Yeah, let's get started with this portfolio management. Typically, from an exam standpoint, in level one, hardly the weightage is 5%. But probably you should look at this as what you would be doing at the end of the entire CFA. Because that's the reason level 3 constitutes almost 55% weightage only to portfolio management. So level 1, the focus is more just to understand the basics of what we mean by portfolio and the basic calculation. Some of them we must have looked at already in quant. The portfolio risk calculation, the formula used for finding out the portfolio variance and portfolio returns. So slight building on those kind of calculations and understanding the basic context behind the creation of the portfolio. That's what we are typically looking at. Though the entire subject is split into 4 chapters, the size of them is relatively smaller and but very critical, because any subject which is having a very less weightage from an exam standpoint, the onus is there in terms of making sure that you don't miss out any of the questions, because one question wrong could result in a percentage falling drastically. So that from that standpoint, it adds a lot more value, right? And that too, this subject being the core of a CFA, core job of a CFA, it's better to get some kind of a basic hold on it. So the first chapter is giving us a simple overview of the entire process. See, we all know in regular scenarios also, uh, diversification is a very important strategy, right? Probably not just in the world of investment, right? Let's say if I'm only looking at one X particular kind of a job or X company X kind of a job, probably it's more risky for me rather than keeping my options open a little bit, right? So that is what we are calling as diversification. I mean, it is applicable in almost every world, right? Probably instead of specializing in one single subject, we try to do dual specializations, we try to do a lot of things just because we want to keep our options a bit more open, which are what are nothing but diversification strategies. And because of that diversification, what we are trying to achieve is we are reducing the risk, right? The same logic is going into the world of portfolio also. Investing in one single security is going to sometimes it may be very profitable, sometimes it may end up into a big loss also for us. So that is where the whole of portfolio management as a concept has come up. Diversify with an intention to reduce risk. That's the major. If at all I have to define portfolio management in one single sentence, I'm doing a diversification with a prime intention to reduce my risk. The not with an intention to generate abnormal profit. Portfolio management never targets at generating abnormal profit. It primarily targets at reducing the risk without compromising too much on the return. I compromise on the return, but with a little compromise on the return, probably I may be able to reduce my risk drastically. Risk is nothing but what? Uncertainty in the amounts which I am going to get. So probably it's like getting 50% profit with a 5% chance, are losing 50% with a some percentage chance versus getting 10% consistently. That is what portfolio management tries to achieve. Okay, your profitability 50% fine. If that is not assured, then probably it can really have a big impact on your overall profitability and your overall well-beingness, because as long as it is doing well, you're happy. The moment it doesn't do well, you're losing out. But the portfolio is created in such a way that even if one of them is not doing well, the other one will do well. Both of them are compensating each other. Because of that, you may not gain heavily, you may not lose also heavily. And the portfolio management is always looked at from the negative aspect, right? It prevents my, or I don't use the word prevent, at least it tries to reduce my downside, right? Prevent is a very wrong word to use there. It reduces my downside, it reduces my chances of loss, or even if I lose, it reduces the volume of the loss for me, especially when I'm going with it. So here in this, the key topic that plays a role is correlation. The moment I'm choosing two securities, based on the correlation between them, I have to choose. If the correlation between those two securities is very, very high, we'll demonstrate it when I'm doing the calculation. If the correlation between the two securities is very, very high, there is no diversification benefit literally. Only if the correlation between them is very low, probably -1, that is where the diversification benefit actually comes up, right? And we have to understand that portfolio doesn't mean it's a loss prevention. It does not guarantee anything, but it's a mechanism where you can work out to typically reduce your chances of loss. And on that grounds itself, we have what is called as a modern portfolio theory. What it says is, any investment which you are trying to do, don't look at it only from the return perspective. Always evaluate it from the risk plus return kind of a standpoint, not just from a return standpoint. You use risk as well as return to evaluate the portfolio. So, any return expectation you are going to have, you have to believe that there is an impact of risk also in that exercise, right? So so from that standpoint, it has even brought out a calculation called diversification ratio. What this does is very simple. You create a portfolio, and for that portfolio, you find out the standard deviation or the variance of that portfolio, and you look at the individual securities which you have created in the portfolio. Let's say I had shares of Infosys, I had some shares of Wipro, I had some shares of DLF, right? Now I know the individual standard deviations of each of them. I take a simple average of the individual standard deviations that is there in the denominator. In the numerator, for whatever the final portfolio that I have formed, what is that final portfolio? Probably 50% in Infosys, 30% in Wipro, and 20% in DLF. Using this combination, whatever the returns that come, I can find out the standard deviation of that. That standard deviation divided by the average of the individual standard deviation is what I am calling as the diversification ratio. So the denominator is a simple average. The numerator is actually the portfolio, right? So if the number comes down drastically, if the ratio value is much lesser, it means that my portfolio is a very good portfolio, because it has reduced the risk quite drastically, because standard deviation is a measure of risk for us. So the standard deviation has come down means risk has come down drastically by the creation of a portfolio. So the lower I get that value, that is, I'm getting a very good diversification benefit by creating this kind of a portfolio. That's one thing, one way we can evaluate the goodness of the portfolio, right? I'll look at the diversification ratio. If the diversification ratio is close to 1, probably there is no benefit that I am getting by doing this combination. Whereas if the diversification ratio comes much below 1, 0.5, 0.3, the lesser it comes down from 1, the best is the diversification benefit that I get out of it. So now when you look at it from the other side, which is from the various people who actually use this portfolio management process, you see literally everyone needs that portfolio management process. right? If you look at individual investors like us, we use portfolios because see, most of our investment needs, they differ in terms of time horizon. Sometimes we do for an investment for a short term, sometimes for a long term. Some of us do for a short term, some of us do for a medium term. So, and there is a risk tolerance level that differs from each individual to individual. I may be a risk taking, you may be a risk neutral, he may be a risk averse kind of a person, right? So the risk tolerance limits changes. So the strategy which we generally adopt, the portfolio management strategies that we generally adopt, are based on these characteristics of the any participant whom we are looking at, or probably the income needs. Income is nothing but, do I need a regular source of income from that investment, or can I lock my money, or am I not interested in getting anything in the middle? More of is it, if it is accumulated, is it fine, or do I need something in the middle? That is what is my income need. Let's say for a retired person, there is no point for him to accumulate something for 10 more years and receive everything after 10 years. For him, it would be better if he receives something month on month, right? So, and probably for a person, for a youth, for a young person, probably because he is earning and all, he does not require everything to come every month. For him, it's better if it comes as a lump sum after 10 years or 15 years. So that is what we are calling as income need. Do I need some kind of income in the middle, or can everything be accumulated? Again, that changes from person to person. And the same way, liquidity. If I want to get out of it, I have invested. If I want to get out of it, can I get out very quickly? That is what we are talking of, the liquidity. So some people, in sometimes, because I plan for a long term, I'm least bothered. Let's say I'm purchasing a house. I've invested in a house, right? That investment, let's say if it is purely for staying purpose, I really don't bother whether it can be sold so quickly, if at all I have to sell it. I'm not that much bothered. Even if it is slightly remote, I don't mind taking it, because for me, the intention of purchase is staying. Whereas someone who has purchased the same house from an investment standpoint, he looks at these attributes more. Oh, does it have a good resale value? Does this location have all locational advantages and all, so that if I just put it for sale, there should be a buyer immediately, and I should not compromise on the amount at which I can sell. So different people look at different attributes. So from an individual investor standpoint, all four keep varying from a person to person. But if you look at others, for example, insurance companies, time wise, if you look at life insurance companies, they don't mind long term investments, right? Because generally any policy that a person takes is not for a 1 year period. They generally take a 10-year, 20-year maturity kind of policies. So even the money which they are receiving in the form of premiums, they can invest for a 20-year period. So the time horizon generally for life insurance companies is longer. So they have to choose those kind of investments where they can get a long-term benefit. Whereas the general insurance companies like vehicle insurance and all, we generally pay the premium once in a year, right? So for them also, they should be prepared to settle the claim immediately also, right? So they plan for a short term period. Any investments, see, investment for them is whatever you are giving in the form of premium. All of us pay premiums, so they have to better utilize those premiums to get better return. So from a time standpoint, life insurance companies generally look at a long-term perspective, whereas general insurance companies look at a short-term kind of a perspective. And even the risk tolerance, they cannot take much of a risk at all, right? Because it's someone else's money. And the intention of insurance is never profit generation, it's more of risk mitigation. So in a move to generate extraordinary profit, they cannot compromise on the loss side. So that's where they generally don't take any risk. and they don't want any income in the middle also, because either on a death they do the settlement, or probably on maturity they do the settlement. Nowhere intermediate. Very couple of policies could be there, money back in the middle, but even there also only 2 or 3 intervals they do the refunding, but not every month. So their income needs are typically much lower, but the liquidity needs should be much higher whenever they have to sell off, because if they have to meet the claim, they should be able to cancel that investment, pull out the money, and immediately make the settlement. So from a liquidity standpoint, any investment they are doing, they need to look at the high liquidity need. So if there is a lock-in period of 5 years, it doesn't help them. Whenever they want to sell off, they generally don't want, but if some cases come that they have to sell off to make the settlement, let's say they have assumed that this person or this set of people will not die within the next 1 year. But if suddenly it happens that so many people within that age group are dying, they may not have the buffer with them, right? So they need to sell off so that the claims can be settled. The same logics probably you can see now from an insurance company. So where do they put their money? Those investments that are available in the market, which will suit all these needs, that is where they will try to put their money. So whenever we are looking at portfolio management, we have 2 dimensions. One is the client dimension. These are all our clients. Let's say I am a portfolio manager. For me, any of these guys can become my client. Individual can become my client. The insurance company can become my client. The bank may become my client. Any of them may become my client. So one side I have to understand is the needs of the client. So this is what are the needs. So typical framework to understand the needs of the client is these 4 dimensions. One is the time dimension, 2 is the risk dimension, the income, and the liquidity needs. Now if I look at the same from a bank standpoint, they generally don't want to invest for long period, because most of their amounts today in the form of deposits. You don't know when they will do the withdrawals. So from that standpoint, you should be able to meet their requirement quite quickly. So the most of the time investments which banks do are very short term in nature. Again, they also cannot take any risk, because on the deposits it's a guaranteed amount which they have to give. So they cannot take much of the risk, but they require some intermediate incomes, because they have to pay interest on a regular basis. They keep paying the interest into the accounts on the regular basis. Like insurance company, they don't accumulate and pay on maturity. They deposit the interest into the accounts every quarter. So there is some kind of income need for them. And same way like claims, if people are withdrawing, they should be able to sell off their investments, get the money, and pay for the withdrawal. So the liquidity needs are also higher. And probably look at a few more sets of people here. Foundations or endowments, like a college fund, right? Any endowment fund is probably like a NGOs, they set up some funds, or foundations, they set up some fund, or prime minister fund. These are like your endowments kind of funds, wherein the general purpose of their establishment is not for some period, forever. That fund may exist generally, at least when it started, it starts with an intention of forever. Some college fund. Every university may have its own fund. So that fund generally is a very long term, probably eternal existence is what you can talk about, right? So some funds keep coming into them. They invest that fund. There is no time period, right? So generally their time horizons of investments also are very, very long term. They don't mind taking risk. One bad year, no issues. One good year will compensate it. So because it's a long term, they don't mind taking some bigger risks also. And but whatever are the monthly or yearly expenses that come out, see, it's like a lump sum. Let's say a building fund started. All of you have contributed some money for this building fund, I put this building fund in some investment. All the apartment people have contributed some money. A building fund got created. This money got invested somewhere. The investment for me is in such a way that, okay, let it be there for a long term purpose. As long as probably it gives me some income every month to take care of the maintenance expenses for the building, it should be sufficient enough. For eternal, let it be invested. Every probably in temples and all, people do this, right? They run an eternal fund for all kinds of pujas or food or donations. They take donations that is created into a fund, right? And it is invested for a long term. Whatever the interest that comes out of that investment is used for the regular activities, right? Even when they take donations from you, also they typically give a similar kind of message to you. You give you make your payment one time on your name. Probably some kind of activity will be done for next X number of years. I mean, it's not even specified. Forever is what they generally talk of, because that amount is like put into a fund which is a long term. Whatever the returns that come out of it, they will use it. So what we are trying to say is, different parties, they have different needs with respect to time horizons, risk tolerance. Defined benefit pension plans are nothing but pension, right? From a pension standpoint, if you see, yeah, if I have to create a pension fund also, probably for a person like me, the pension will start flowing after 20-25 years. So I can invest my money up to that point. After that, it requires that it gives me some constant source of income. And until that time, because I will not even disturb it, I am not even thinking of selling it off. Even if the liquidity need is much lower, I don't mind. So what you have to typically see is, when you are a portfolio manager, you understand the need of the client first. That's the first stage in the portfolio management process. Who is your client? Is he an individual or is he any of these entities? Identify the characteristics of the client, and once you are clear, that is what is the planning phase. Identifying the needs of the client is what is the planning phase for us. What all the things you need to understand there? You try to understand his objectives. What are the objectives? We'll discuss in detail, but how much return he is expecting out of this investment, right? If I have to create a investment strategy for you, I have to ask you, what is your expected return? 10%, 15%, 50%. What is your expected return? How much risk you can take, right? Again, both of them have to be matched. If you say I want 50% return but 0% risk, then probably I may not be the right solution provider to you. You may have to approach someone else. So by understanding these two objectives, the risk objective and the return objective, you can think, oh, what kind of securities are available in the market to address this risk return combo, right? So you are trying to understand the objectives, preferences. Does the customer have any specific kind? Oh, I don't want real estate. For whatever reason, the customer may say, I don't want real estate, you put my money anywhere else. So those are some kind of preferences and constraints. We'll talk about constraints in detail. Probably he may say it should be liquidity need is very high. Whenever I want to sell off, I should be able to sell off. So once you sit with the customer, you will get these kind of interesting discussions from him. From there, you target the allocation part. Once you create a detailed IPS, investment policy statement, or sometimes even in detail it is called as WIPS, written investment policy statement. You actually get it written, right? In some cases it is even required by law also. Sorry. So once you prepare this investment policy statement, it's just like a guidebook, rule book, so that tomorrow the customer doesn't complain. This guy did not give me a solution what I wanted, and even you don't need to complain that the customer has given something else, and now he is complaining something else. It's like it's though it's not a contract, right? Though it's not a guarantee, it at least says, okay, probably it sets a direction for me. Okay, this client, this is the objective, these are the constraints. So do I have any kind of securities or assets where the money can be invested for the client? That is what is happening at the planning phase. So whatever I have documented in the investment policy statement, we are trying to map with the current economic status, current financial situation in the country, and based on them trying to identify what assets are available and do the investment accordingly. So when I'm doing the execution phase, which is the real investment part, we are talking about the asset allocation strategy. Asset allocation is nothing but where do I put the money now? Now this is the objective for him. These are the constraints he said. Based on them, where should I put the money? So broadly I will identify, is an equity market good for him? Is it a bond market that is good for him? Is it real estate that is good for him? Is it private equity that is good for him? Which one or which combination is good for him? That is what we call as asset allocation. And in what proportions? Okay, 50% in equity, 50% in debt is good for this kind of a person. That is what we are calling as a asset allocation. And that asset allocation, we can do it in two ways. Either it could be a top-down based, which means I start with the economy. In this economy, yeah, these industries are booming well. Or probably this asset group is doing very well. Equities are doing very well, especially when the economy is in a boom. So let me try redirecting a big proportion of the investments into equity. So I look at, and within the equity where, then again I may see, probably the pharma sector is doing much better compared to other sectors. So the next thing will go as, okay, within the equity, let 50% of the amount go into the pharma sector. So you are doing that kind of a breakdown. And within the pharma sector, which company? That is what is a top-down analysis. Or sometimes you may do a bottom-up, wherein you are starting with company itself. See, typically we call it as EIC analysis, economy, industry, company. Or you will say CIE, the reverse. So you are starting directly with the company. Which companies are doing well, irrespective of the industry and the economy? Right now, which companies are doing well? Invest. Sometimes what people may do is, it's a combination of these two. Just identifying the industry or just identifying the economy. In this kind of an economy, invest in these companies. Invest in this kind of an economy, invest in these companies. So it could be a combination of top-down as well as bottom-up kind of an approach also. So once you identify, yeah, these are the sectors that are good for him. These are the asset groups that are suited for this person. You will do an analysis, detailed analysis of each and every security. That is where you may evaluate their financial statements. You may evaluate their futuristic growths. You may do a lot of valuations and financial models on each and every security, and shortlist on, okay, these 10 companies are good for this person's investment. And then you will see, as a part of portfolio construction, how much in each. Is it equally 10% in all 10? Or is it 20 here, 2 here, like that, making it 100? What is it? That is what we are doing as a part of the execution. And of course, as the economy keeps changing, even our plans have to be continuously revisited. That is what going as a part of the feedback process, where I keep doing the monitoring and rebalancing. Rebalancing is probably pulling out some money from this investment, putting it into something else. And probably if the economy is changing, probably it looks like equity market is no more attractive now. Suddenly I may have to pull out the client's funds from the equity market and redirect it into the government securities kind of markets, because they are more stable. So depending on the economic situation and all, and on a regular basis I'll do the monitoring and even the rebalancing of the strategy. And there is a performance benchmark that is typically set, right? Like what is the return, or against what number I should compare. That's a performance benchmark. And am I continuously meeting that, or am I lagging behind? So I set a benchmark and do the monitoring against that particular benchmark. Now, the important thing is, now we are looking at the other dimension. Till now, the client, understanding different kinds of clients. And now the next part is, what are such kind of portfolios which are generally available in the market? There is a small difference. Typically, we use a lot of funds. There are so many funds that are prevailing in the market: mutual fund, hedge fund, private equity fund, venture capital fund. There are so many names of funds that are available in the market. The simple way to define them is, it's a portfolio. Any fund is a portfolio, right? Probably, let's say you are a venture capitalist. If you invest in one new business, you are a venture capitalist alone. So you are taking a big risk, because if that company works, you will get big return. If that company is a dud, you will lose. That is the way you are working out. Rather than that, probably you look at 10 more people who are similarly like you. All 10 of you will pull in some fund. That fund is in turn invested in 10 different companies. Instead of one fund in one company, right? Let's say there are 10 venture capitalists, and each of these 10, on a one-on-one basis, they have invested in different businesses. So what could happen if two businesses are successful out of this 10? Two venture capitalists are making huge profits. 8 of them are making huge losses. That is the way the venture capital industry works. Now, what is happening even in that industry? These 10 venture capitalists, they are pooling a value into a fund called as a venture capital fund. And this pooled up fund is in turn invested in 10 companies. So if a loss occurs also today, 8 companies go off, 2 companies benefit. That 2 companies benefit goes to all 10 venture capitalists, because it's a fund that is investing, not one single person that is investing. These people, the investors invest into the fund. Fund in a way invests into the businesses. So depend on the proportion of the investment these people have done, the overall profit, whatever the fund has generated, these people will share the profit in the proportion of their investment. So instead of one person getting 100% profit, probably here 10 people will get 10% profit. So again, it's a risk mitigation kind of a strategy. So the purpose of any fund which we come across is pooling of the money, investing it. Even when we say mutual fund, the same thing. Pools the money from all of us and invests it in some stocks, some bonds. The intention again there also is very simple. If you have to buy some shares, with the money whatever you have, hardly one company, 2 company shares you can buy. But if I pool a big money by taking some amount from each one of you, now I am one single entity. Even if I buy one share of Infosys paying 3,000, all of you are getting 1/100th of that share. But you cannot buy 1 by 100th of the share literally. You have to buy one share individually. Right? Whereas as a fund, if I am buying one share of Infosys, you are getting 1 by 100th share in that. Right? So that is one of the prime reasons funds are nothing but they are portfolios itself. But then what is the difference between these two? In a real business parlance, fund is something which is run by a separate manager called a fund manager, and he makes the investments as per his research, as per his knowledge. Whereas when we are saying a customized portfolio, we are talking of as per the interaction with the client, the investments will change. So it's primarily the simple way to define between a portfolio and a fund. Fund is more like a buffet, whereas your customized portfolio is more like your a la carte. Right? The fund manager decides everything in case of fund, where to invest that money. Whereas in a typical customized portfolio, it's a client. See, in the other case, all the clients are contributing money to the fund. Let's say I'm talking of X mutual fund. A lot of individuals have paid money into the fund, but they don't direct where to invest. The fund manager decides where to invest. Whereas in case of customized portfolio, if you are a client, you are giving money, even if I take a decision, I have to communicate, I have to discuss with you and take a decision. So that is what is the difference between customized and productized kind of thing, which is a customized portfolio versus a fund. So now we are trying to see what are the various kinds of funds that are available in the market. The most common one being a mutual fund, right? Pooled money, invested in stocks, bonds, indexes, everywhere. It is mentioned at the outset itself where it would be invested. Where in the sense? The broad. 70% equity, 30% bonds. Such kind of broad base would be given as a part of the initial definition itself. And in this fund, we actually differentiate between two types. A closed-ended and an open-ended. As the words are saying, the ending date is closed here. It's not closed in open. Which means you have a specified ending date for the fund, which is more similar to an IPO process. The fund starts on 1st Jan. It closes on 31st Jan. What does that mean? The total amount that comes into that fund, you cannot buy new shares after 31st Jan. Whatever comes within that 1 month period, they will allot new shares. The fund will allot a new share corresponding to your investment. Whereas after 31st Jan, it's a simple trading. When you are selling, I have to buy from you. When I am selling, you have to buy from me. Which means it goes through a market, through any exchange, trading. So depending on the market value, the value can go up, go down. So it's purely a trading process after that. Those are all closed-ended funds. Whereas in case of open-ended, in closed-ended, the price that it is trading in the market may be different from the real worth that is available in the fund. Real money that is available in the fund, let's say initially all of you have pooled some money with me. I have invested somewhere. I am getting some benefit on those investments. The fund manager's work. He is getting some benefit out of that investment. So whatever is the net value that is present in the fund is actually called as NAV, net asset value. Like let's say all your money pooled up to let's say 100 crores, right? I have invested that entire 100 crores. And let's say after 1 month, though I have not sold any of them, but I just calculated what is their worth in the market for all those shares and bonds, whatever I have looked at. I have just calculated what is the worth of all of them in the market. So let's say it has come out to 105 crores. After all deductions and after all payments and everything, let's say it is around 80 crores. Or let's assume 105 crores itself. 100 crores you have invested, it has become 105 crores, right? That is what we call as net asset value, which is nothing to do with the amount at which the mutual fund is trading in the secondary market. Because these two are isolated. This is what a fund manager is doing. The price that is available in the exchange is the market demand and supply force. Right? More demand for this mutual fund, the price go up. Some other fund getting more demand, the price here will go down. It's more of a demand and supply there. Whereas the net asset value is more of reality. How much is the total worth that is available with the fund? So these two can be very well different. That is where people call, in a closed-ended fund, the trading can happen either at a premium or at a discount to the NAV. Sometimes it could be more than NAV, sometimes it could be less than NAV. So the proper term that is being used is, it is sold either at a premium or at a discount to the NAV. Right? In case of open-ended fund, what typically happens is there is no ending date at all. There is nothing called 1st Jan, 31st Jan. At any point, people may get into the fund. At any point, people may exit out of the fund. So, any buying or selling, that is directly going into the fund itself. It's not 50 crore shares which is fixed. Probably if you are a new investor and you wanted to buy some fund worth 10 crores. So it doesn't mind, the number of shares may go to 51 crores, or you pull out another 100 crores. The value of the number of shares may come down to 41 crores. So there is no secondary market in case of open-ended funds. Any buying or selling directly happens into the fund itself. It goes directly to the fund manager, no trading here. Any buying and selling is directly going into the fund itself, which means the fund manager's job is very difficult in case of open-ended fund, because suddenly he'll get very high money to invest. Suddenly, if some people may pull out their investments, he has to act accordingly. So, the job, whereas in case of closed-ended fund, he knows, okay, his amount is 500 crores. He has to invest, and whatever the returns that they generate, he may have to reinvest. But at least he knows 500 crores, probably I can plan out. Whereas in case of open-ended, that's not the case. Tomorrow it may become 700 crores. The day after tomorrow it may become 600 crores again. People pulling out, people adding in. So that's where in an open-ended fund, what we see is any buying and selling that happens at NAV only. Because we are directly buying into the fund itself. There is nothing called demand and supply here. If there is a limitation in the number of shares, probably more demand, it will increase the price. But here there is no concept of limited number of shares. The shares are unlimited. So because of that, what could very well happen? Buying and selling happens only at the NAV itself. So that's where in closed-ended you will talk about trading at a discount or a premium to NAV. Whereas in case of open-ended, you are buying always at the NAV itself. So like that, again there are so many categories. Again depending, exclusively stock funds, which means the money is invested only in stocks. The pooled money is invested only in stocks. They are called stock funds. Pooled money is used only in bonds, bond fund. The pooled money is used only in short-term money market instruments, very 1 year maturity kind of instruments, which is typically we call as money markets. So the pooled money is invested only in money markets, treasury bills or certificate of deposits or commercial papers which are hardly 1 year maturity kind of instrument. So they are called money market funds. Sometimes there could be a combination of all these: 50% equity, 30% bonds, 20% money market. They are categorized as balanced kind of funds. You do some kind of balancing by doing some kind of allocation. So like that, mutual funds is a big form of portfolio management. Today there is a concept of exchange traded funds, slightly a mix of open ended and closed ended. The features are more like, from a closed ended perspective, it is traded. The exchange traded fund is traded in the market. So that is the characteristic of a closed ended fund. The price, when it is traded, what should happen? Immediately the market price should either go up or go down. But what the ETF typically does is, it immediately buys back the number of shares or creates new shares into the market to adjust this increase in the price. So if the market price has gone up, suddenly the fund value also goes up by creating some new shares. Some new shares get created, the fund value will go up. Overall, again, per share, the value is coming down. So the number of shares are automatically updated based on the demand and supply. So there is a trading part in the market, and there is an allocation of the number of funds also, which is a mix of both open-ended as well as the closed-ended features. And so from that it is traded on the exchange, and most of the times it mimics an index. Mimics an index is like, probably if it takes Sensex, just the way the Sensex is computed, probably some percentage weightage to Reliance, some percentage weightage to ICICI Bank. So just the proportions in which the Sensex is computed, this also invests in the same proportion. So all 30 Sensex companies only it will invest, and the proportions it will invest also is exactly the same. So if Sensex increases by 10%, even this fund also will increase by 10% itself. And at the same time, it can be traded. So because there is no research involved in this, right, it's just a mimicking. There is no in-depth research to beat something. It just go with the trend. So that's where the fund management charges are much lower, because there is no active research that goes in. But in a normal fund management kind of a process, the portfolio manager or a fund manager has to do enough research in terms of where should it invest. Whereas when we are talking of an index fund or mimicking of any particular index, whatever the proportions which are used to compute that particular index, I'll follow the same. So most of the times what happens, they get traded at the NAV itself, because the number of shares get automatically adjusted. So it's not, though there is a market trading, what you see is it gets traded more constantly at the NAV itself. Today we have a large number of ETFs that are floating in the market. Almost on every asset there is an ETF. There is a gold ETF. There is a stocks based ETF. So the index, the Sensex based ETF, Nifty based ETF. So there are so many ETFs that are available in the market. So that is also a kind of a fund. And the next category of funds which are worth looking at is the hedge funds. Probably very new compared to many other kind of funds. See, the hedge is a word typically used for risk mitigation, lessening of the risk. A fund that is created, but the reality of this is it doesn't invest in low risk funds. Hedge as a word means reduce the risk. But so hedge fund as a theoretical concept, it should give me a kind of an indication that the pooled money is invested in riskless kind of securities. But they do the opposite. They do invest in high risk taking securities, but at the same time come out with the hedging scenario on that, which means, okay, if this goes into a loss, is there anything else that can give a gain? See, let's say this I am thinking emerging market. So I'll invest in an emerging market. Okay, if I am invest in emerging market, my expectation is in future it will grow up and it will give me a big return. But suppose emerging market is down. Is there anything else that can compensate it? So what they do is they do calculations on the correlations. Which are the two markets which are quite opposite? Or what they do, they buy some shares, immediately they sell some other shares. They buy some, they sell some immediately. Because of that, what is happening? Or probably buy in one market, sell in the other market. Identifying the price differences that could exist in both the markets without any risk, or they are reducing the risk in the entire process. Because here buying is also assured, here selling is also assured. So the whole profit or loss which I get is more or less assured. So they play a kind of scenario where the overall risk is mitigated for them. Though they take risky investment, but they come out with a mechanism to mitigate that risk. Probably today derivatives are used to mitigate risk. So they combine the stock investments with derivative investments to make sure that the overall risk is drastically reduced. So they do that kind of combinations, and because they are completely or to a large extent exempted from the reporting requirements, which means the regulations are not that heavy on a hedge fund today. Probably a mutual fund is subjected to so many regulations by the regulatory bodies, whereas hedge fund is largely unregulated. And because of that reason, there is even a requirement that the number of participants in the hedge fund cannot go beyond 500. Number of investors. Number of investors into the hedge fund cannot go beyond 500. So what the hedge fund does is, from each single investor, probably it looks at a very minimal investment of at least $1 million. So it is right now accessible only to high net worth individuals who can contribute heavy amounts, right? Because all regulations don't apply, and at the same time they are free. See, if I just for an example, when you are talking about a mutual fund, there are so many regulations which say probably you can't invest heavily in derivatives, or something which says you cannot sell without owning, which is typically the game in the investment market, short selling. Without owning, I do a selling. But as far as mutual funds are concerned, these are all the regulations. You cannot do a heavy trading in the derivatives. You cannot get into short selling. Whereas the hedge fund guys are free to do whatever they want because it's not regulated. Right? So generally, they are very much for high net worth kind of individuals. And because there is a big challenge in terms of managing this kind of a fund, even for a fund manager, the package is extraordinary. So he is paid generally on 20% on the performance. To what extent excess return you are able to generate without taking risk. It's the simple funda here is generate a return with almost assurity. Or sometimes people use this statement very commonly regarding this hedge fund. You cannot give an excuse that the market is bad. Whether the market is bad or good, you have to generate the profit. That's the way the hedge fund has to work. Because In theoretical, you are not taking any risk. In theory, you are not taking any risk, which means even if you are taking it, you are coming out with something else which will reduce that. In a way, you are taking any risk. You are not taking any risk. That is the concept of the hedge fund. So, the intention is you have to generate profits in all the markets. So, if you are able to generate it, you will be paid, compensated very heavily for that. So, that's where the charges are much higher. So, what they generally do is long short is one strategy. There are so many such hedge fund strategies. We'll see in the later stages also. Long short is I buy in one market, immediately sell in the other market. Or I buy one type of shares. Let's say I buy Infosys shares heavily, I sell Wipro shares heavily, thinking that both of them have equal amount of risk. So if I am losing here, I should gain here and vice versa. That is the long short strategy. One buy, one sell immediately. Then we can have event driven kind of strategies. Let's say merger or acquisition happening. The target and the acquirer. Right? Probably they buy the shares of target, sell the shares of the acquirer immediately. If they assume that probably after the acquisition, the target share price is going to go up and the parent share price is going to go down, they'll play this strategy. So some kind of event driven kind of strategies, or there could be emerging markets versus established markets. There could be many such kind of strategies they get in, but the most common strategy for them is if you are buying something, you sell something immediately. And the gap between that buy and sell, which is what is the profit, they want to make that profit risk free. And that's where there is a term associated with that. That kind of a profit without taking any risk is what we call as arbitrage kind of a profit. And if at all some fund is managed by the government, we call it as a sovereign wealth fund. The pool of money which the government invests, we call it as a sovereign wealth fund. Then we also have two other types, private equity funds and venture capital. Venture capital I have already discussed. A pool of money, right, from all the various people. That money is used in new businesses. Right, that is what is going for a venture capital fund. The same money, if it is used to buy out some existing firms, we call it as private equity fund. Some stake in already an existing established firm, we call it as private equity investment. If we are taking that money and putting it in new businesses, we call it as a venture capital. Otherwise, there is no difference between the two. All of you are pooling money. There is a manager who is taking care of that. That person, if he is investing the money in new businesses, completely new ventures and everything, we call it as venture capital fund. Right? There is a big risk there because only some firms will sustain. Some firms may get out of the business also because they are all new companies in which you are investing, and that too very vague ideas is what you will look at. So some of them may be successful and grow drastically. Some of them may be a complete flop also. So that those kind of investments are called venture capital. Whereas in case of private equities, what they do is they try to buy out some existing public company. They buy all the shares of that company or some majority stake in that company. So what happens? That private company, that public company today becomes private. Let's say you are a public listed company with 1,000 shares. With my money, whichever I have, pooled money of all of you, I have bought out all the shares of this company. If I buy out all the shares, then there is nothing called public limited. I am making it as a private company. Now on a private company, what I'll do all kinds of restructurings, remodelings. As a private company, I have full control on my business. If it is a public company, every step which I am taking, I am answerable to the shareholders. So now I have a full control. I can give all my thoughts into the business and remodel it, restructure it. After few years, get it back into the public. That is what a typical private equity buyout fund, when I say a buyout fund, it is primarily targeted for that. It's again pooled money. With that pooled money, I am investing in so many, I'm buying out the stakes of some public limited companies, making them private, restructuring, and again releasing it to the public at a very high price. So whatever the benefit I get is the difference between these two. Right? So like that, today there are so many investment vehicles that are available in the market. So from that standpoint, understanding the portfolio becomes a very interesting aspect, both looking at the client side as well as the products that are available, because at the end you have to map these two things to come out with the better solutions to the client. Right?